Hello, everyone. My name is Jay Sawyer. I'm one of the directors on the Willow Creek Farms MUD Board of Directors, and I'm going to share with you some of the work that I've done behind the scenes in planning for our exemptions this year. Now, I'm recording this video ahead of our monthly February meeting. I don't expect we'll make a decision on the exemptions there, but we will start talking about it. I will share this analysis with the other directors. They will have an opportunity to work with the spreadsheet as well, so that we can come to a consensus by March or April on what the exemptions are going to be. So even though I'm recording this ahead of time, it's not going to be released until after the meeting starts. Not that I'm trying to be secret about it, but because this is going to be related to decisions that we may be making at the next open meeting, want to make sure that I'm not in violation of the Texas Open Meetings Act. So this video is not going to be released or published until after that next meeting starts. All right, so now let's get into the fun stuff, which is this super busy spreadsheet that I've put together to help me with planning. So some of the key things that I want to point out here, and we're going to get into more detail on all of these than you probably want. But some key things I want to point out here is projected budget. Now, our current total budget for the current fiscal year, which ends June 30th, is about 2.2 million. In this case, I'm budgeting and I'm using 2.75 as an estimate projected budget. Things like inflation, as well as additional costs for some of the parks planning that I'd like to do, and some parks projects kind of get rolled into this. Exactly where we'll end up, we still haven't done our budgeting, so this is kind of a guesstimate moving forward. And then what is our projected water and sewer revenue? So this is going to be the revenue that y'all pay from the water bills. This is actually probably low. From a realistic standpoint, we're probably looking at around more like 1.4, 1.45 million, but we'll use a low number to keep it conservative, 1.25 million in overall water sewer revenue. The difference between these two, we have to make up in our M&O tax. So that's how the M&O tax goes to fund in addition to the water and sewer revenue. It fills in this gap. If you had to fill in that gap with your water sewer revenue, it would be huge. Then we wouldn't have the additional income also from Texas Heritage. A month of reserve. One of the things that I'll be looking at doing is how much reserve can we pull in to apply to help drive our tax rate down. Think of it like buying points on your mortgage, right? So how much reserve do we plan to use to fill in and make sure that we meet budget? We have 17.3 months of reserve. A month's worth of that is about $187,000, $188,000. So I want to keep in mind how much of that we can use to kind of fill in those gaps, so we can start drawing that budget down or drawing that reserve down and using it to fund tax cuts. We do want to maintain at least 12 months worth of reserve, but 17 is probably a bit more than we need. Plus, we've got Texas Heritage coming, not next year, but the year after, that will allow us to refill those reserves as well. So we can pull them down just a little bit, still stay above 12. Texas Heritage, we have more revenue and more taxable value come in from the marketplace. They're going to be at a higher tax rate. So we can use that to replenish those reserves at that time. Again, planning out 2-3 years ahead of time. So how much pending homestead? So I've talked a lot in the past couple of years about the homestead cap. Using that homestead cap has really helped us to do similar things like this, but really rely on the homestead cap for the increase in taxable value that allowed us to issue the exemptions while managing our tax rate. So the pending homestead, that is really about it. That is a fraction of what we have seen in the past few years. We had a point in time where something like 85% of our homesteads had homestead cap, and a lot of those had more than 10% in homestead cap. that is just about gone. This is pretty much the last of it. And then, what are our current, so how many disabled and over 65 residents do we have that we issue exemptions for? What our current homestead exemption is, what our current disabled over 65 exemption, M&O. So these are all of our current rates, how many connections we have. This is going to help us calculate costs, as well as, things like, what the tax rate is, if the tax rate has changed, and that kind of stuff. All right, so next, what do we have to look at from a financial standpoint? Well, so the first thing is the budget that we have to meet. So this is what we need from our M&O budget to make sure that we meet our projected budget over here, while taking into account the projected water and sewer revenue. So this 1.5 million is very simply our projected budget minus our projected revenue gives us 1.5 million that we need to fill in from the tax rate. Now you'll see in here, I have a rate discount and an HOA rate discount. This is to give us a calculation of what we do with the water rates. I've mentioned that I want to reduce the water rates. So I'm including a discount in the water rates in here in the planning. Those right now, a $10 discount on the average residential water rate, a $5 discount for the HOA. The cost of those two discounts is about $140,000. So we need to make sure that we account for that as well. This gives us a total budget to meet of $1.64 million in order to operate the district. Now, in addition to meeting our operational budget, we also need to make sure that we can pay off our debt. So that is not as simple to calculate. So we have a bond payment schedule. Now, this bond payment schedule we get this from our financial advisors. I've translated it into Excel. So that way it gives me an idea of what our bond schedule is. It adds in the total debt service. We can see what values it's using, calculate a increase in value, in this case, 1% increase in value, and a long-term interest rate of 1%. These are probably quite low, which is good. We want to be conservative. And then we want this next year service right here. We always want to make sure that we have enough for the next year. We do not want this to drop below 0%. Of course, in this time frame, we are going to see a pretty large jump, but this gives us a nice conservative balance sheet, which is what the financial guys like to see. And certainly we want to make sure that we pay off those debts. Now, over here, because we're working with the exemptions, these exemptions will actually impact the value over here. So this gets pulled from the other worksheet that I'm working on. I'll talk about this additional balance, but these will get added in as well as whatever rate that I specify over here will get added in, and then it will give us an idea of what our next year service, what the minimum value is in that column. And again, we don't want this to go below 0. So there's two things we have to do. We've got to meet our operational budget, and we've got to make sure that we can pay our bond debt. And in order to do that, right, we've got different sections or different portions of that tax rate. And it's literally taking our taxable value and calculating what our tax revenue would be based on our taxable value, and very literally moving pennies around. And that's what we're going to see, kind of how that works. So our taxable value is the big thing that we need to guess when we're doing this. Now, previously, just last year and the year before, we had the homestead cap coming in that we could count on and that we use to help calculate what our upcoming taxable value was going to be. This year, we don't have that. We have a little bit from the pending homestead, about 3.2 million. That's not a lot. You can also see that I'm doing a calculation on value increase or value loss. Again, I'll talk about that in a bit. So this gives us a change, how much we expect the taxable value to change, and then what our new taxable value is. From here, we calculate based on the exemption, how much revenue we'll generate, and then also this feeds into how much the bond payment and the bond schedule. All right, so essentially this allows me to move some values around and do a simulation to understand kind of what our values are going to be and to get to that 20% homestead exemption that I really want to get to. So things we don't know. We don't know what the appraisal value is going to be. We don't know what WCAD is going to do with those. We don't know if values are going to increase or going to decrease. Talk about that in a second. We also don't know what the change is going to be for Texas Heritage Marketplace. So you'll see I have all of these kind of broken out separately. So in this particular scenario that I'm looking at right here, I'm estimating for purposes of this worksheet and for planning, $10 million of increase in value for Texas Heritage Marketplace. I think that's probably conservative, but I'd rather go conservative than, be wildly optimistic. And these are the things that I'd rather come under than go over. The other thing is, what is the value change? Now, last year, we actually saw a decrease in appraisal value of about 7%. Now, that didn't impact us quite as much because we still had a bunch of homestead cap come in and get applied. And so the decrease in value was offset by those homestead caps to a pretty large amount. We don't have that. So this value change is going to have an impact on us. Why do I think 3%? Again, I think that's a very conservative estimate. All right, so what's WallerCAD going to do with the appraisals? Hard to guess. But what I do know is that they look at sales. So I was able to get all of last year's sales from Garrett Weathers, who's one of the real estate agents here in the neighborhood. I know he's offered to help folks protest their property values. So this is going to be, the same data that WallerCAD is going to be looking at. They may also be looking at, neighborhoods around us, but I'm focusing really on the values here for the homes sold in Willow Creek Farms last year. Now you'll see we do have some that are way under their 2025 appraisal. This one in particular, the appraisal was $675,000. The closing price was $514,000. So the close was 76% of the appraisal. So this appraisal should come down to $514,441. But this also makes me wonder if this was a person who should have fought their property appraisal. So Garrett is always happy to help folks protest their property values. There's also a video that Tony Comita put out there on how to go through the process and how to protest your property values with the CAD. So definitely make sure you do that if it's appropriate. Save yourself some money. But you'll see these are kind of on the low end. Most of the values are in the upper 90s. We have this one that is at 122% of the appraisal. Not really sure what went on here, 111, 110. Our overall average is about 102% of appraisal, so about a 2% increase in value. So I think looking at a 3% decrease in overall values, maybe we'll see that decrease on that high end. Most of the homes are under 450,000. Our average homestead value, our average appraisal is, I think, around 400,000. So most of these homes are on the lower end of values, but not extremely so. These are still pretty representative of most of the homes in the district. All right, so let's go in and take a look at how this particular model is working. Right, with a 3% average loss in homestead value, this $10 million increase in Texas Heritage is really kind of the key to making this work. I think 10 million is in increased value is probably conservative. I know we've signed off on millions of dollars of payouts, and there's been more. This, I'm hoping, will come in higher, but I think I'm being pretty conservative to make sure that we don't wind up in a really bad position. The value change, as I mentioned, I think this is, again, being conservative. So a 3% loss in value gives us a total of $7.8 million in taxable value for the homesteads, a loss of $2.4 million. But because of this additional $10 million from Texas Heritage, the actual drop is $272,000. That's the actual drop in our taxable value. We also include in here a discount on the water bill. So this would be the water bill for everybody, a $10 discount across the board, $5 discount for the HOA water bills. So these will come right off the top for your bills, save you $10 a month, so $120 a year. It's the start, right? I want to get those down lower, but we got to start somewhere. The total cost for that is $140,000. So we've got to meet this budget, and we've got to meet it by moving things around here. So our new taxable value based on our exemption, the exemption basically reduces the taxable value. It has a certain cost associated with it based on the appraisal value, not the assessment value, the appraisal value. So that appraisal value drops by 3 million, 7 million, 10 million. So 14 million when we go up to that 20%. When we go up to that 20% taxable rate. So that gives us a base taxable value, right? That's right here. Our new taxable value is $385,434. So that's at 14 million off. Now this we have to feed in to our bond payment schedule because this serves as the base rate here. So as we change this, right, we want to change this to match our target exemption amount, which is going to be 20%. If I change this, say, to target the 18%, you'll see that the next year service, that increases. Right, so I want to make sure that I'm targeting the right value here to get us to that 20% exemption rate. So I'm going to target 385 for that 20 million. We add an additional 3 cents into our bond rate, and we can meet our bond obligations through the lifetime of our bonds, really in a very conservative world. Now, in order to minimize, I don't want to go above 117. This is that 2 cent increase that I was talking about when I was first talking about increasing the exemption rate to 16%. That was kind of how I had planned it out, kind of as our worst case scenario. That's what I'm doing here as well. This is our worst case scenario. But at 117, this really winds up being a tax increase only on the commercial and rental properties. We still have a tax cut at 117. When we go up to a 20% exemption, we have a 3 cent tax cut for our resident homeowners on their on their tax as long as they have that homestead exemption. So we can actually increase the tax rate for commercial while decreasing the tax rate for the folks that live here and own their homes here in the neighborhood. So love how that works out. So don't freak out when you see, oh my God, they're increasing taxes. Yes, we are, but we're increasing them for the commercial to help us pay for the additional exemption for the homeowners. Now, in order to keep that under 117, we drop our M&O by a penny. Now, if I don't include any months of reserve, this doesn't work. We do not have enough money coming in to cover our expenses. But we do have 17.3 months of reserve. And so we can start applying some of that reserve to our budgeting. I'd say, okay, we're going to pull in 2 months of reserve. That gets us pretty good at a 16 or an 18% exemption amount right here, right? We're meeting budget across the gamut with at 18%. We could probably even, I think at 18%, we could probably even get down to $1.15 and probably make that work. But at 20%, we probably, in this kind of scenario, we probably need to go up to 117, still a cut for our residents. And then 2 months isn't enough. We add in 2.5 months worth of reserve. So that's going to be, let's add this in. A total of, 400, there it is. The reserve applied here, $469,000 that we're pulling out of our reserves. Sounds like a lot, but again, that's only about 2.5 months worth of actual reserves that we have. And so that right there would take us down to 14.8. Probably another month or so. And this is probably about the most reserve that I would want to allocate. Maybe if we get let's do 2.3. See how much of that is. 2.2. So it looks like maybe we can even come down a little bit more. Yeah, so just 2.1, and we're still in the green here. Barely in the green here. Right, we're accounting for 1,640,816, and we need 1,640,280. So this is just barely meeting it by the skin of our teeth. Again, this is the numbers that I'm using here, I think are pretty conservative. But this is going to be something that as a board, we're all going to need to look at. This spreadsheet will, of course, be available to other members of the board. I will also make it available for residents to download and take a look at. Hopefully you've seen kind of the different things that we can use to move things around. You come in here and change what the different tax rates are, and you'll notice that if we keep the M&O at the same, let's get minus 0.01, right? And you can move all these numbers around and kind of see how they change based on assumptions that we make on what's going to happen with the property values. And again, when we do the exemptions, because of the way it works, this is kind of how we have to do it. If we want to make sure that we grant as much as we can in the exemptions. You can also look at the impact of increasing the disabled and over 65 exemption. There we go. Yep, so I didn't quite get everything in there, but you can see that changing this is one of the easier things for us to change because we only have 139 disabled over 65. We can move that up. So we may look at, say, moving that up to 25,000 and increase that there too. The impact on our budget is relatively small, so we can afford doing that. But again, it kind of plays with all of the different values. This is kind of what I'm looking at, though. The scenario that I'm going with, $10 million increase in Texas Heritage, 3% loss in homestead value with our $3.2 million in pending homestead. Use 2.2 months worth of reserve. That gets us to where we need to be in order to issue that 20% homestead exemption, which is what I want to get to, and that's what I'm going to be proposing to the board. One other thing that you will see in here is this. So what this is a calculation of the back taxes that we will get from the ag exemption. So when the ag exemption is canceled, you have to go and you have to pay 3 years worth of back taxes. Used to be 5 years with interest. They cut that down to now 3 years with no interest. But it's still a chunk of money that, is kind of outside the normal thing. So I did do a report based on property values to determine which ag records came from Texas Heritage. So which ones will be qualified to go back for 3 years. And those are represented here, and then add in what our rates were for those years. This right here, based on my calculations, we're looking at another $135,000 in M&O rate revenue when that comes in. Not quite a month's worth of reserve, but certainly not zero. The big thing is this $219,000 into our debt revenue. If we add that in, so like, for example, if I add in the 219.9, let's just do 210. Let's go low, right? You'll see when I add that in, the requirement that we have for our bond service. Oh, that was wrong. We can pull a penny off of our bond service. There we go. And that takes us down to 116. And we can still meet all of our obligations. And we could maybe play with this, maybe put this at 0, and then use less months of reserve. Looks like 1.5. Okay, so 2 months reserve if we come in, if this comes in, but then we'll also have this other 135. So again, we start adding that in, we wind up getting into even better shape. So more money that's coming into us from Texas Heritage. Let's go ahead and remove this and put this back up to where it was. So, but look forward probably in April or May, we will, maybe even March, we'll be adopting our exemption. So in the next couple of months, we'll be adopting our exemption. I will certainly announce it, post it, let everybody know, and let everybody know what it's going to be. And then we'll see if these values come in. That's always, very honestly, that's always a risk, right? If this $10 million doesn't come in, or if less comes in, we can actually still make things work a little bit, but we're really going to have to pull down those reserves, probably get into a situation where they're a bit lower than we want them to be, which means it will take us longer to reduce those tax rates. This is how I'm thinking. This is how I'm looking at it. And I hope this has been educational and useful for y'all. And so with that, I'll go ahead and let y'all go. I'll post a link to where you can download a version of this. The post will be read-only, but of course you can make your own and play with the numbers. You'll also be able to see like all of the numbers that I've collected behind the scenes to get an idea of the financial condition of the district and some of the things that go into it. And if you have any questions, certainly feel free to ping me. Let me know. Happy to talk about this with you. Okay, till next time. Again, I'm Jay, on the board of directors, and I've been showing you kind of the goo behind how I plan for the homestead exemption.